Michael Yardney here with another Ask the Experts question. Thank you for sending in your questions. I'm going to put these to Ken Race, who's going to help you with your property tax structuring, asset protection, and be able to pass on your wealth to future generations. So welcome again, Ken.
Thank you, Michael.
Now, Ken, this is a question that has been sent in to us saying, I've read that successful investors control everything and own nothing in their own names. Ken, I think the first time I heard that many, many years ago was Robert Kiyosaki says that, doesn't he?
That's it. Yeah, it's become a coined phrase now, hasn't it?
It
Very
has.
meaningful.
And what Darren's asking is, I'm looking to set up the correct structures for owning a significant property portfolio in the future and was considering setting up a trust. We own a home and one investment property with a mortgage. Well, congratulations, Darren, for getting that far. Sorry, you're saying here you own it in your personal name. So his question is, are trusts the right vehicle? And if so, what sort of trusts? And I heard some protect assets better and keep them in the family. Is that right, Ken? Ken, I think, and you role as Director of Metropole Wealth Advisory, that'd be a reasonably common question you're asked.
It's a very common question, and it actually goes to the root of I think, what a lot of people are trying to achieve, and that's the creation of wealth. And with anything you do, you've got to actually begin with the end in mind. So with Darren wanting to build a substantial portfolio as opposed to, I just want to buy a home, you've got to look forward and actually then start looking at what is the best way to hold and therefore control and manage that wealth. So for a lot of people, trusts are the optimum vehicle. For many, though, it's not. That's why you've got to go and get specific advice. But there are many different types of trusts, and they all work completely differently. And it would depend on things such as, are you a PAYG? Do you own a business? And if so, how do you operate that business? Do you operate it as a sole trader, out of a trust, out of a company? So we've got to go through that machination of questions to then determine if the trust is the appropriate vehicle, which is the best one for that particular circumstance. So for you, Darren, it would we would need to look at those issues. Where was your main income source as the first step to answering which type of trust?
I guess what we're saying, Ken, is you can only give a really general question this way because there's so many variables. So when you sit down with clients, you go through all that. But I think the other interesting point that was made was some are better at maintaining the assets in the family unit. We've all heard of unpleasantnesses that occur when your kids divorce, your kids split up, and you really don't want the outlaws, is that the right word? The in-laws until things go wrong, but you don't want them to get the assets. Is there a way of protecting things, Ken?
Look, and that type of trust, which is extremely flexible and gives predominantly the best asset protection, is a discretionary trust because it has so much discretion. But colloquially, it's been coined a family trust because it's the sort of trust you wouldn't do probably with business partners because of its great flexibility and discretion. So that is the sort of trust that you can hold assets, you can move them from one generation to another, you can change control of that trust without triggering capital gains, stamp duty. But if you've bought a property that is, at least initially, not creating enough revenue to pay all your expenses, if you're on wages, you can't fund that loss with pre-tax money and get a tax deduction.
I guess in other words, Ken, what you're saying is you're not getting the benefit of the negative gearing if an asset is in a trust, as opposed to if it was in your own name, you'd minimise legally your tax.
Correct. I was actually trying to steer away from the word negative gearing because it's created such connotations of lately. I mean, all it is a business, a property that you just bought. It is a business. And as a business owner, you have to have a mindset of a business person. And a lot of businesses start off in the negative. And the reason you get that tax deduction is because you anticipate making a profit in the future and paying it back. So in that family trust, those losses, that negative gearing are trapped in that trust. and you still have to pay the bank, of course, but it's with after-tax money without a tax deduction.
Of course, you can keep them for the future. You don't lose the benefit. So in 50 years, you'll get benefit, Ken.
Correct. When you eventually sell it, you can claw back that. If you're on a wage, for argument's sake, and a trust is appropriate.
Sorry, Ken, to interrupt you and I talk over you, but if I'm not mistaken, you don't actually have to sell it, because in future years, if you are making money or you are able to distribute money into the trust, those carry forward losses can be taken advantage of.
Correct. So when it's finally in profits, you're then eating into the previous losses. So you're actually not paying taxes on those initial years where you become profitable until you've eaten up all the accumulated losses. So very good vehicle for asset protection, estate planning. You know, I have a lot of clients who come to see me who want to create some wealth for their children and want to pass on that wealth, a property, before they die. They want to see their children happy with the assets. So in that family trust situation, you can change control of that to the children without triggering the taxes and the stamp duty. So you don't have to wait until you die for your children to get benefit.
I guess what I got from that, Ken, is there are many questions to ask, but in general, Darren, you're right. Owning things in your own name, especially if you're in certain jobs, professions, industries where you're at risk, may not be smart, and owning them in structures is important. I think Ken's message is right. Begin with the end in mind. Where do you want to be? Having said that, I found that for a lot of investors, for the first and second property, sometimes it's just not worth the expense, the trouble, the hassle, and the difficulty getting finance in a trust. So this requires specific advice for your particular circumstances, Darren. And can I throw one last little question in, Ken? There's another type of trust that maybe we should have a separate session on, but that's called a testamentary trust. Can you give us just a little hint about that?
Yeah, testamentary trust, you know, from the term, you know, your last will and testament. So that's a trust that is set up on your death, but you make provision in your will for that trust to be set up. And that gives you monumental benefits as opposed to passing the assets on your death to your children, to them in their name. Much, much better to put it into a trust, a testamentary trust, that they then control. Huge, huge benefits. They just cannot be underestimated, the benefits, but most people don't know about it and therefore don't do it.
Good. Well, I think that's going to give us the opportunity to have a whole separate segment just on that, Ken. But another benefit, just to quickly mention, is when you die and you do pass it on, there's no capital gains tax or stamp duty involved in passing it on to a testamentary trust, is there?
No taxes at all. No, the benefits come after.
So the comment, I guess, to make is that if you're looking to set up your structures correctly before you purchase a property, or you currently have assets and you're wondering how to structure the next one, or structure yourself correctly for one day when it comes your graduation day, let's put that nicely, Ken, the right time to do it is when you're in the position to make certain decisions rather than the short term. So seek a professional advisor. Thanks for your help, Ken.
Thank you, Michael.